Hello guys and welcome to another different video. Today taking an in-depth look at four companies that reported earnings this week. So we have Amazon, Google, Palantir, and if I remember correctly, PepsiCo. The first one is Amazon. Also, I think you've noticed today we're using a different template. We're using Ticker Data's valuation template. You can check it out in the description below. It's pretty cheap. And also, if you noticed, they have this template that also has these formulas that are automatically calculated based on real-time financial data. So I think I love it. Now, first of all, let's start with the business metrics. Their current ratio is 1.04. The return on tangible assets is 6%, and their return on equity is 15%. Why did I start with these three? Well, first of all, the current ratio, what it shows is that they have good short-term liquidity. Return on tangible assets is important for their kind of business, since basically they're retail. Return on equity 50%, suggesting a capable management, because usually when return on equity dips below 10% in a company that has been profitable for quite some while, that means that management is incompetent. Uh, Either that or they never to buybacks and their net income has been the same, because equity is basically the surplus of net income. So net income over 10 years accumulates, and if the net income doesn't grow, then it becomes a smaller and smaller percentage of the equity. Their return on invested capital is 8.2%, which is okay, and their cash flow per share is $8.42, which, to be honest, is quite low, so just because their stock price is $230. So yeah, that's pretty low. Now let's start with the Grams valuation. Grams valuation has been adjusted because the old valuation was a bit too permissive. If we use it, we get very high values and they don't make sense, which is ironic since he was a very big value investor. And we need to see the estimated EPS, which is 7.17 for 2025. And using this, we get a buy price of $160. Now, next, let's move on to the discount cash flow model. And let's use a perpetual growth rate of 2.5%. I think actually that's pretty good, to be honest. And let me think. Um, Wait, adjust is 5%. No. I think that'll go there. Um, the thing is with Amazon, they've gone their free cash flow a lot. I think it will. Mm, I'm not sure. Let's put it at about 8.5%, or actually no, 9%, because their cloud business is growing a lot. So as you know, cloud is much more profitable than retail. So I think that their free cash flow increase more. Um, and let's adjust the perpetual growth rate to 3%. Now we're using this valuation. We get a price per share of $87, which is much lower than their current price, of course. They're using historical multiples and multiples valuation compared to other tech companies. We get a average price of $112, and now move on to this DDM. We can do it because they do not have a dividend. Now, applying a 15% margin of safety, of course, we get an acceptable buy price of $104. So the stock is trading basically at half of at twice its intrinsic value, and pretty close to 2.5 times its acceptable buy price. So I guess Amazon is just not a buy. Next, let's move on to Google. Google, I think you'll find quite more interesting. Let's enter our most recent full fiscal year, 2024, and let's let it load a bit. A bit of commentary on Google. I actually own this stock, so please take everything with a big grain of salt. But what is very interesting about Google is that they are the least, actually, I think they're undervalued. And well, we'll see if they're undervalued, but compared to the other tech companies, they're doing much better in terms of valuation. and I think it's much more interesting of an opportunity. Now I mean, their balance sheet is perfect. All of their return metrics look ROIC 26%, the current ratio 1.83, return on equity 30%. There is really not much to add here, other than the fact that they are extremely well managed. Their balance sheet, their management is quite capable. Of course, they lack in the AI sector. Their Gemini 2 came out recently. It's a joke, but yeah, their core business makes a shit ton of money. What can I say? Now let's start with the grams valuation. Google's, wait, let me check for a second. Google's 2025, we're using 2025 EPS estimate is 9.03. So 9.03. That gives us an intrinsic value of 211.9 dollars. Using a DCF, we can see that their free cash flow has grown considerably, and I think they deserve a 10% growth rate until 2032. So about basically 9 years. Um, all right, technically speaking, 8 because 2024 has actually passed. And a perpetual growth rate of 3%. I think that's good. So a price per share of $192.72. Next, historical valuations. You can see that they're trading below their historical valuation of 29 times earnings. And their multiples valuation, we can see that they're undervalued. Look, as I was saying, they're well below their competitors in terms of their tech uh, the other tech companies. Apple trades at 33, Meta at 29, and Amazon at 52, 51. Dividend discount model, it's not loaded, so I guess we'll just eliminate it. Dividend discount model. Actually, it's loaded. Sorry, I misunderstood. But I don't do the DDM because I think it's unwarranted in this case. And using a 15% margin of safety applied to the intrinsic value, we get an acceptable buy price of $202.4. Suggesting the stock is a buy. And I actually agree with this. I personally did a DCF much more in depth for myself, and I found the intrinsic value to be somewhere in the to 30 to 40, something about the somewhere in that area. So yeah, I think they're a buy. Next, let's move on to Palantir. I actually disagree with a lot of shareholders of Palantir. Palantir, to be honest, is too hyped. I do not believe they deserve any of the valuations. And I'll show you immediately what I mean. What we immediately see is their 0.67% free cash flow yield, which is extremely low. Their insane 600 price to earnings, which is absurd, and their pretty low ROIC of 5.451. I know their margins will increase, but still, they're insanely overvalued. I will just immediately go to Graham's valuation. I need to wait a second until I find Palantir's earnings per share. So Palantir 2025, as always, we'll use 0.55. So 0.55 EPS. We get an intrinsic value of $12.91. So less than almost a tenth of the current price. DCF will just, I don't know, I'll plop in 15% growth rate. Actually, no, if you know what, I'll make it 20% just to show how absurd this is. So actually, no, even I'll do it even more, 22.5%. So even with a 22.5% CAGR for 9 years, so for 9 years, see what I'm saying? They only get an acceptable buy price of 39 a price per share, and this is with a perpetual growth rate of 3% and a discount rate of 8%. Now, historical multiples, we can't really calculate it since 2023 was the first year they actually had a positive price to earnings. Multiples valuation, well, it's hard to compare since technically speaking, we can compare to other tech companies, but at the same time, they're not necessarily like other tech companies. Their sector is much more defense focused, their business, I mean, and DDM we can't use. So using a very generous DCF with Graham's revised formula, and actually I removed the multiples, we get an intrinsic value of $26. So $26. See what I'm saying? $26 for a company that is trading at 111. So this is extremely overvalued, and I'm not sure if you agree, but I mean, there's not much to add here. And the last company on our list is PepsiCo. I think that's Pep, right? If I remember correctly. Let me check. PepsiCo. PepsiCo, of course, I think you know what PepsiCo does. I don't think I need to introduce you to this business. It's very old, very boring business, might add. They have good metrics for 14% ROIC, 0.8 current ratio. Could have been better, but still it's okay. Return on equity 53%. Cash per share 675. Free cash flow yield of 3.42%, which to be honest, for such a low growth business should have been a bit higher. Yeah, let's start with the Grams valuation. So their 2025 estimated price to earnings is, sorry, EPS is 8.44, and using that we get an intrinsic value of $195. A DCF, let's calculate it based on a, I don't know, 3% growth rate and a 2% perpetual, because I don't think they deserve more than that. Since look, you can see their free cash flow here, it's the same as in 2015. And this is not to, this doesn't account for inflation. If we add inflation, it's actually much lower today than in 2015. So even 3% is generous. And we get a $64 price per share. Historical valuations are trading below them. Multiples valuation, well, I will remove that because it only references tech companies. DDM, I think it's wait, I get a too big of a, this is why I don't use DDMs, because DDMs are much too generous. I'll just do it 2%. Yeah, 2% growth rate. This is much more real, much more realistic, since if their free cash flow only grows at 3 or 2%, they can only grow their dividend at 3 or 2%, because if they grow it too much, then they'll have big problems. And let's remove this. Actually, I think the DDM would have been, yeah, the DDM will reduce the intrinsic value even more, so I'll just leave the discounted cash flow and Graham's valuation. And using both of these, we get an intrinsic value of $130. Applying a 15% margin of safety, you get an acceptable buy price of $110.7. So, yeah, this is not necessarily too overvalued, but still, it's a business that, accounting for inflation, has actually gotten a reduction in free cash flow over the past 10 years. So there's really not much to see here. If they manage to somehow turn the ship around and manage to increase their free cash flow at 4 to 5% per year, then yeah, they deserve the current price. But if they don't, there's not much to add. There's not much to gain from buying PepsiCo. Google is much better, is a much better buy. Actually, believe it's a great company. I own it. Of course, during the diligence, this is not to be considered financial advice, as you all know. Do not take my word for it. But yeah, I think Google is a much better opportunity than all of the other stocks I present in this video. Yeah, I think this has been it for today. I hope you have a great day, and also do not forget to check out Ticker data from the link in the description below. And I hope to see you in the next video. Bye.